Good morning, beautiful people of the internet, and welcome once more to our Sunday special property chat. Joined as always by Helen Chorley, Adam Lawrence, Piotr Rusinek, and myself, Jay Howard. And
Mm.
it's not all doom and gloom, says the sage of Solihull. There's some good news this past week, some positive shining lights, some beacons of positivity in the market to keep everyone alive and away from those dreaded pills and the jagged blade. So Adam, give us the lowdown. What is so exciting to be living today? Why
There's
should
a,
we all be looking up to the sky and thinking, wow, there is a greater purpose than the toil and trouble that we are bound to on the day-to-day living of our existence?
I like the little Jakari's window you open there into the life of a property investor, developer, and trader there with the jagged blades and the pills. Um, well, I did say last week that probably the best medicine was to switch off the news for a week, and sure enough, that would have worked pretty well. Although you could probably say that would probably work pretty well most weeks, to be honest. But we've sorted out the debt ceiling, which was the inevitable sorting. The market hasn't calmed down a lot, which probably tells you, when the market doesn't move a lot in these situations, that tells you more than when it does move a lot. So you do need to sort of bear that in mind. But nonetheless, things have calmed down. Bond yields have gone the right way. We've trimmed 0.25% off. I did have a bit of a blast at the Bank of England today, and not really specifically the bank, but very specifically the governor, because I'm really getting quite fed up of him, and I was very upset when I looked at his. I looked up that his term ends in March 2028, which is just what a gig to get. I'm not sure. It's not a Liz Truss moment, but I'm not sure he can really stay in post till then. He certainly doesn't deserve to, in my opinion. But it would be quite something that took him out. Although in today's society, all we need is a couple of inappropriate comments or a tap on the bottom somewhere where it shouldn't be, and that'll soon get rid of him. So maybe there's some woke justice coming Bailey's way. We can always hope. Um, but ultimately, yeah, bond yields have improved a bit. I've done one of my becoming more and more in demand bullet point lists near the end. I'm sure it's so people can just skip through and not read the rest of it, really, which I can understand. Certainly, some weeks as I've tipped over the 3,000 and 4,000 word mark a number of times in the recent past. We're a little bit more disciplined today, but ultimately, it's not a week next week to go and rush into take the first mortgage that you can because things are calming down. I'm annoyed. I'm somewhere between annoyed and angry. I think we've discussed before how the older I get, the angrier I get. So I'm trying to keep a relatively level balance. But if it was me, and I'm not suggesting that it should be me because I'm far too much of a maverick to occupy any form of official or corporate position. But if it was me, I'd have shown a bit of leadership this week and gone out to the press and said a couple of things about what I'm going to do with the interest rate or where my thinking is at if I was Andrew Bailey. It was the week when the governor should have spoken, and I think he's probably on holiday or something instead because he's just done nothing at all apart from be pilloried a bit further in different parts of the press. The Telegraph are really it's their favourite main course at the moment, smashing into Bailey. And for once, I wholeheartedly agree with them on that. And yeah, no one, he didn't even send out the chief economist to do any of his legwork for him, didn't do any of that, just silence. Oh, we might need to intervene in the pension markets again. Oh, jolly good. Don't even know if you need to or not. It's not ideal to any stretch of the imagination. But ultimately, it's not been a week to sort of panic. It's not been a week to go and grab particularly high interest rates. We've already seen this play out once before, although at least at the time we had a lettuce to throw eggs or whatever we threw at her at, and someone to blame. And then we had a seeming, the tapestry to the markets would have been, okay, we get it. We got a blithering idiot in charge, but look, at least we got rid of her. And now we've got a guy who's quite sensible. We'll force a really dour and near sociopathic chancellor on her, and then we'll keep him in place when we get a much more sensible PM in place, which of course what did happen and did calm the markets down quite a lot. This is different because really what's come about is, yeah, we're finally admitting the inflation problem's bigger than we ever thought it was. We've really dropped those transitory narratives. We've got a core inflation problem that it's not really serving the bank very well to be talking about, but it is far too high. And part of the bad news around that, really, from our perspective as the UK, is that everyone else does seem to be over the hill, including the ECB, who are similarly led by a pretty bloody useless individual, in my opinion, who's more politically motivated than anything, which is not helpful when you're supposed to be an independent economic organisation. But there we go. But they seem to have conquered, or the odds are they've conquered the hill of their core inflation, and the market's a lot more comfortable when things are trending downwards rather than trending upwards. So, yeah, as I said, not a week to panic, but there could be 2 or 3 weeks. If you're waiting for a mortgage at the moment, or many mortgages, as is often the case in our operation, there's probably 2 or 3 weeks of just general calm, because we saw this in, mid-October, late October 2022. Landbay were one of the first back to the limited company buy-to-let markets with some fairly intelligent products and some fairly reasonable pricing, and so were Paragon. And then the other lenders sort of filtered back in over the following 2 to 3 weeks. And it's always good for there to be a bit of competition, stating the blindingly obvious, but it's always good for there to be a bit of competition.
One of the things that I've been seeing a lot on Facebook groups is people complaining more than usual about the kind of information lenders are asking for, and the kind of requirements lenders are making people jump through. It's have you guys been experiencing this kind of stuff as well, and in the day-to-day running operations of the business?
It's a great question. What we've got, I was on a fairly long call to a bank, not Friday, but Friday before last, where that case has been in for, it's entering its 12th month of underwriting. Now, it's a decent sized portfolio, but they have been unspeakably slow. They're very apologetic about being so slow, but you can imagine how nervous we are, because they're holding a rate for us of 4.04%. Which obviously looks, and it's for a really significant sum of money. So it's concerning to say the least. But they've assured that we're at credit now. Hopefully all is good, but it's going to be extremely costly if that's not good at this stage, obviously. So yeah, more of those sorts of calls, definitely more. Random requests like, I want to see proof these 8 mortgages have just been paid on time in 8 different limited companies. It just seems like a sadistic underwriter, that does, to be honest with you. And of course, they could just look on the credit safe or whatever else they subscribe to see if we've missed any payments. So that's extremely, extremely annoying, because they don't seem to care about how much of your time that they waste. And
what do you think? What do you think this is driven by? Is it that the lenders just want to ensure that they're lending to people who will pay, or is it just to kind of drag the process because banks are uncertain about what's coming, and is there another option?
I think they would say the former, but the latter is more true. Credit is tightening. There's no two ways about it. The figures bear that out in terms of new mortgage. It's difficult, because it's always difficult. But January 2023's figures were not great for mortgage originations and all the rest of it. But then when you think about it, we were still reeling from a Liz Truss style effect in the housing market. So how much of that do we try and take out of the equation? But what's happened in the past sort of 2.5 weeks is going to impact. You'll only see the impact of that in maybe August or so, or September, something that I talked about today, which is interesting, because we've gone from a world where seasonality was almost not gone from the marketplace, because these other COVID factors took over so much more strongly than seasonality. And this year, for the first time, it looked like seasonality was really coming back. But then we've had a kind of a stab in the gut for the market at the end of May, which will then have an impact, which could lead to a quieter than what would otherwise have been a relatively quiet summer. Now, I referenced the fact that, transactions are down 9% since 2019. And this is we all get ourselves obsessed with nominal prices. And I've talked a lot of times about really we should look at inflation adjusted prices, or Rod's done some good stuff in the past about the price of a house in gold or in barrels of oil or other stuff. That sort of stuff is relevant because it gives you a peg, a permanent peg, especially something like gold that reacts to the price of inflation, of course, as a famous old inflation hedge, and these things are relatively important. And we've got a market where, yes, I think lenders are going to be more cautious, but they're kind of where you end up is they're looking back at what they have lent on, and now they're holding that against you for new loans, which is the wrong way round to do things. But none of them will want loans that are in distress. None of them will want particularly bad credit books. But there are obviously going to be, if we do see 0.5 at the Bank of England meeting later this month, we're going to start seeing potentially and we see another. If we see a 0.5 and then a 0.25 early August, that's the meeting after the next one, first week of August, first Thursday of August. We're going to be approaching some quite interesting administration situations, I'm sure. And it is administration rather than straight to receivers generally, because there's still equity in these assets. And the only time there won't be equity will be months and months and months down the line if there is a readjustment and a repricing. But if this core inflation keeps bubbling, it actually perversely will act as a kind of cushion. And this is a not in the same way, but the late 80s, early 90s market, you saw very flat pricing and maybe a peak to trough of 10%, but you had a huge roaring inflation rate, which made it look less bad than it was. But that was on the back of a trebling in prices between 1980 and 1987. 20 grand the average house price in the UK still was in 1980. If you can even get your head around that, given that, you can barely go on holiday with a family for 20 grand these days. That's how ridiculous inflation has got. Maybe that's a bit of an exaggeration, but I like to keep it luxurious if we can get it.
It almost sounds like we're being asked to dance for our dinner just a little bit. It's not just a case of this is this. It's like you have to go through a whole performance to get the nourishment you need, whether it's within yourself or within your investment. I think
as well, you've got to think about credit risk, right? What's wrong with the current situation? In 2021, they could borrow money at basically zero, right? And if let's just focus on the short term development and bridging market, right, for a moment, yeah. So keep the numbers really easy. It cost them nearly nothing to get the money, right? Maybe 0.5% or something crazy like that, yeah. Mm-hmm. And they could lend it out at 10%, let's say. So there was a 9.5% margin or a 20 times return. Obviously, you've got operational costs, you've got all of those things, of course you have, but the margins were utterly phenomenal, right? Mm. Then you move to a market like today where the base cost of the money is 4.5 plus swap margins and the likes, right? 4 to 4.5. And they're still lending out at, if we say 10 for 2021, let's say 12 today. That's about where things have moved to. So we've seen a 9 times the cost of the money, right? Or 4% eroded from the margin and only 2% go on the price. So logically, if you were lending, you should have been quite loose in 2021 and you should be extremely tight in 2023. So that does make economic sense. But of course, the other problem is in the financial sector, the music wants to keep on going, and these companies are all looking to push more money out the door. And if they only pull in, there's a funny thing that really irks me with a lot of the arguments of the left, where they consider inflation and the cost of living and everything for everybody else. But if a company's profits go up 7%, they talk about it like it's an outrageous slight. Whereas in real terms, if profits are up 7%, then in real terms, they were down 3% when inflation was 10%, right? So what inflation affects everybody, right? It absolutely affects everybody. The only winners can be the government, as long as the fabric of society doesn't pull itself apart. And the problem, or one of the problems we've got, which, to be fair, the Labour Party are allocuting quite well. I'm not sure it will get through to the electorate, if I'm really honest with you, I'm afraid. But the problem is, ultimately, we've had no real growth of any note for years and years and years and years and years. And we've got this economy that's sort of bumbling along the bottom. And my fear is we bumble along the bottom for another year or 18 months, and then we have a recession. So then we've lost the thick end of 10 years if we do it that way. And you can lose decades, because just look at the aforementioned Liz Truss's favourite economic model of Japan and the Japanese economy. You know, they used to talk about the lost decade in the 1990s after the crash of the Nikkei, but they now accept that's actually 3 lost decades, because standards of living really haven't improved since 1989, which is just incredible. Now, we're very different, fortunately, than Japan, primarily because apart from anything else, we've got such large net migration. And, you know, it's one of the things that's going to cause a problem at the next election, purely because the Conservatives, in their infinite wisdom, under David Cameron, decided to say things like, we'll be down to the tens of thousands, and forecast this year at 800,000. Now, look, I'm pro-migration, and Boris was pro-migration, and no politician worth their salt is anti-migration, really, although you might question about Suella, realistically. But even her, I don't think is anti-migration. She's just anti-illegal migration and frames it in some of the most aggressive of terms that you could imagine. But I guess in many ways, I suppose that's her job. I mean, the last however many Home Secretaries, I mean, my opinion of Theresa May improved when she was Prime Minister, because as Home Secretary, I thought she was a terrible human being. And then we've had a crescendo of more terrible human beings since then. God knows who's next. I don't know. You know, it'll just be I don't know who they've got left in the locker, but
it does feel like politically the country is falling. You know, in terms of representation, is falling down the ziggurat rather than going up it. Yeah, I don't know what the bottom looks like, but I imagine on both sides it's probably not very attractive.
But, you know, talking to people who are, you know, light users of construction or trades and stuff like that, you can hear, you know, they're now in the world where the plumber's 95 quid an hour, and they just can't believe the prices they're having to pay. And I say, well, if there's one sector that you could say at a worker level, at an individual level, has benefited massively from Brexit, of course, it's construction, right? But it's not a sustainable scenario. Because the Conservative MPs will have a plumber out who charges £195 an hour in Westminster, which they won't be able to put on their expenses, and go, my goodness, we need to ship some of these chappies and chappesses back in, don't we? We've got a problem here. So, yeah, it's interesting, but I think we've got, you know, a pretty. If we assume that the next few months might look a little bit more subdued, a little bit like October to maybe January did last year, because of this wobble in the interest rate market, and it's going to knock a few people off their perch. Remember, what it'll still do is it will mean that it will concentrate that demand towards the back end of the year. So if we saw, for example, an increase in number of cases in administration in, say, Q3 and Q4, which I think is highly likely, to be honest, alongside, you know how the press lags behind with this stuff, and we're trying to forecast the future here. You know, August, September, there could be some really negative headlines out there in terms of the data that's sort of filtered through over the past few months. And if you can't separate the blips from the permanent trends and the problems, the likelihood by then is we may well be over our core inflation peak. I do expect we probably hit it last month, right? But we do need to bear in mind the journey from sort of 7% and core down to 5 is an awful lot easier than the journey from 5 down to 3 without a recession. And rightly or wrongly, we still are bumbling along short of a significant event which will put us into recession. So I'd say the next couple of quarters is visible, carrying on being relatively visible again, really, to be honest.
Well, August would be a great time for bad headlines, though, wouldn't it? Everybody on holiday and distracted and
exactly
or anything.
So it could be a really good time to go shopping. To be honest, and I'm not a fan of waiting, but I did say in today's supplement, it is a time to tighten things up, and it is a time to be picky. That's for sure, because you know there's going to be the trend at the moment is sideways and downwards, and therefore it's a market where you want to be, you know, able to maximise your potential if you've got flexibility to buy. And look at the lender argument from the flip side. At the moment, we can still borrow fast money relatively cheap compared to the cost of it in the past when we look at the cost of the risk-free rate of return. So whilst it might be costing us an extra couple of percent, there's an argument it should be costing us a couple of percent more. So I think maybe we should consider getting on with that and making the best use of it, really, to be honest.
Yeah, this is like what we notice in the auction market. Like people are becoming way more picky with properties, and in fact, it's probably a sign that there's way more opportunities, or like there's expectations of like people wanting certain level of opportunity rather than settling for what a year ago was a great deal. Like now, the same thing is not really a deal because of all the other circumstances around this. And I don't know if you guys see, but the EIG released this another quarterly report about property auctions, and it's a really good one. It's called what was it called? The PAD report.
And property auction data, and they pick a different subject to follow every quarter. And this one, I mean, the first one was brilliant. This one is also pretty amazing. But obviously, it's focused solely on auction markets rather than the market as a whole. But auctions are a really good barometer for how an area and an asset class is operating. So it does reveal quite a lot. You know, there's how certain asset classes are doing in certain areas over the last 5 years. So you can see the peaks and the troughs. Really, really interesting. So we've kind of been digesting that for the last couple of days.
Well, I don't know if you guys have polished off your Property Investor News articles for the month, but Jay's reaction. Well, should we cut the subject? Well, I hope Richard's not listening. And then we'll just carry on. But mine, I've done mine, and it's on London versus the provinces, because for the first time, there's some really relatively positive economic data for London versus the rest of the UK. And that's really quite interesting, and potentially interesting for the property market there, which I haven't really had a reason to consider as a great long-term outperformer of the provinces since about early 2015, really, when it looked like the top was in, and when sort of Prime had lost its steam, middle of 2014, and things were starting to come off the top a little bit. And then it's pleasant to see the overall story on the regional GDP bits is that London is carrying the rest of the country at the moment on that front, and everywhere else started to lose steam in early 2022, which is perhaps why you might see some of the provincial markets just stuttering a little bit more. There are ones that are still strong, southwest, northwest, still doing pretty well. But some of them, you can see why stuff might be trading 10 or 15% even below where its real peak would have been in the crest of the market in early 2022 when things were really bombing forward. And it's quite amazing. And like I said, what tends to happen is not that this really is what is reflected in the land reg, but stuff doesn't transact as much as it did. So I think we're about 30% down on transactions year on year, but we're only 9% down on 2019. So that whereas if you compared that to an 08, 09, we were seeing like a 40% drop in transactions, and that probably, I think that gives you some good relative context about where the market is today versus an 08, 09, really.
It's still a pretty substantial swing. There was some data that Rod put out about the decrease in mortgage products being taken out quarterly and year on year. That was really very interesting. I kind of did a bit of a dive into that, got lost in a bit of a rabbit hole, but super interesting. It just goes to show, a lot of people were complaining the last 10 years about affordability for, getting a mortgage product and all this and all that. That you take the rates now, and that affordability 5 years ago now looks like should have been the easiest thing ever to have got lending.
Well, there's a great stat, and I I appreciate using the words great and the word stat in the same sentence might not be everyone's cup of tea, especially at 9:30 on a Sunday morning. But there's a great stat that comes out from the Bank of England, which is the average price of a mortgage product that's been entered into versus the average price of the average mortgage that's outstanding in the UK at the moment. And the average price of a product being entered into on their most recent figures was just under 4.5%. Right now, bear in mind that is primarily residential mortgages, and then it'll be the smattering of the rest that make up the mortgage lending market. And the average price, let's see if you can get this one in, Helen. The average price of an existing, what do you reckon?
Around 2.5.
Very good, 2.74. So the key really is the gap between those two numbers, of course, because at some point that flip-flops when things are going the other way, and the new rates are lower than the overall average rate. But that what it also tells me is the number that I've been banging on about one of the numbers that I've been banging on about for the past 18 months or so since rates have started to move a little bit is 5.5%, because on the resi, that's where the stress tests were always done. Yeah. So we can't confuse the fact that higher mortgage rates take money out of people's pockets versus people can't afford their mortgages, because they were stress tested at 5.5%, folks, so they can still afford their mortgages. Now, if they're currently, and I've been talking to people this year and trying not to tell them what to do, but I can't help myself, as you know, and say, look, don't sit and wait for rates to don't hang around and take the rates that there were. This is not another chapter 73 of Adam Lawrence Told You So. You know, this is just Adam Lawrence prefers certainty, especially for other people, than volatility, because most people, especially when it comes to property, are not well wired to accept volatility, right? Yeah. And you can see at the moment how that's playing out. But while we stay at sort of 4.5 on the average resi price, if that's sort of roughly where we're going to, and we might see that creep up to sort of 4.75. And we should remember this is not related to base, not directly related to base. So if the bank does go 0.5% this month and send a show of strength, a show of muscle, a show of spine, of which Bailey has none, so I'm not holding my breath. But let's see if the governor for once can do the right thing, because this is for about the 6th time, the biggest Bank of England meeting we've had coming up for some time. But it really is quite an important one. If we do that, swap rates will be back down, and then the mortgage market will right itself again very quickly. And we're only 2.5 weeks away from that meeting. So if any of them are going to say anything in the next week, I'll be interested. As I said, I'm somewhere between gobsmacked and infuriated at the lack of forward. There's not even, Mark Carney called it forward. Much as I have a shrine to Mark Carney in the back garden, as you can see, it's just behind my shoulder over here. But Mark Carney called it forward guidance. Bailey can't do backward guidance, sideways guidance, or I don't know how the man gets to a meeting, to be honest, without a sat nav. I don't suppose it's possible. I mean, it's just no guidance, no leadership, no talent, no chance. 2028, please don't let it be March 2028. Please don't let it.
Which is really interesting, like that lack of, given that the whole narrative, well, certainly for, I was going to say not as long as I was in banking, but certainly as long as I can kind of remember at the moment, is that they wanted to avoid shocks. So it's all about managing market expectations rather than perhaps the public per se, but the management of that. So the complete absence of it is a real, like, sorry, where did we change tack on that? Like,
you tell me another conclusion you can draw, Helen, other than he doesn't know what he's doing. I don't know what other conclusion you can draw. I think I said today, it reminded me of good old Gideon, as is his real name, of course, George Osborne, and how he now laughingly japes about how he learned economics in the job as the Chancellor of the Exchequer. Well, jolly hockey sticks, George. Well done, mate. But it wasn't ideal for all the people that got crushed by your absolutely low-grade policies of austerity at the wrong time. You utter.
Say it.
That one's too strong for a Sunday morning,
That
mate.
one's too strong.
But for reference, it's the big one. It's the big one. That word and that man go hand in hand very, very well.
I think we learn economics on this Sunday special chats.
Would that Bailey or Osborne would tune in, mate? It might do him a favour. You never know.
I think if technical recession is, I think if technical recession is called in, I think there'd be a change of the guard at the bank, central bank, definitely. I think that'll be Bailey out on his bum.
Fingers crossed, mate. Fingers crossed.
I think he just answered the question that just came in, and let's just show it. My buy-to-let is due to October 2024. Is it best to wait until next year?
So that's an interesting one, isn't it? Because last year I was saying very, very clearly we broke everything we had up until June 24, but we made that decision in sort of March, April 2022. So we were kind of looking forward about 2 years. So I'm sure I've got some October 24s, Michelle. So I'll be surprised if I haven't. It'll be one of the only months where I haven't got anything expiring. So we'll be in the same boat on that one. I wouldn't necessarily be looking to pay early repayment charges now, because I think we could be somewhere near the relative peak of the rates. If the market was to calm really significantly, I do still believe that rates are going to continue on this sort of path, but we're kind of at somewhere near the top end of my range for buy-to-let pricing right now. So I don't know why you would take an early repayment charge to be at the top end of the range of the pricing, really. So I think what you need to know is, number one, is the asset performing, right? Number two, are the rents where they need to be in order for you and the tenant to have a sustainable tenancy going forward? Number three, does it need to be related to that? Does it need to be repurposed to short let or HMO? Do you need to consider selling it? Do you need to consider doing something else with it? Can you create extra bedrooms? Can you do this? Can you do that? Those are all really important questions to be asking at the moment, and have a bit of a structured plan. And just remember, in buy-to-let, it's a bit harder in buy-to-let than it is in ordinary resi, but you've got 30 days on a decision in principle. So when you get within that 3-month range, because you're not going to complete a remortgage. Look, you might do if your broker's really good and your solicitor's really good. Good luck with all of that in the current market. But you're going to be looking sort of, set your calendar reminder, July 24. Don't worry too much until then. Would be my take on that at the moment, because I think we've seen a lot of the worst news, and the problem from here is, like I said, we often worry about the wrong thing. We worry about CPI when we worry about core inflation. We worry about nominal house prices when we're better off to look at real house prices when we think about investment performance. And there's a whole lot. We worry about GDP, which is a notoriously bad, metric for understanding how the country is actually functioning. We always do the wrong thing, pretty much, realistically. So what we don't need to worry about now is the base rate. What we need to worry about is the bond yields and the swap rates. And it's not so much that the peak in rates worries me at all. Some of that is because I'm fairly insulated from it, and my stress tests go an awful lot higher than 5.5% base, quite happily. It's not that we have to worry about. It's the duration of time that these rates are going to stay high, and that, in my view, has got a couple of years of legs left in it before. We've got a 1% range, 1.25% range, maybe 1.5% range. They can really trade within and between at the moment, unless we have a really bad economic shock, right? But we're at the top end of that range at the moment. So hopefully we'll be nearer the bottom end of that range when you come into the end of your term. That would be my view.
I think that's a brilliant and comprehensive answer. And we've got another question from Mandy. With the buy-to-let, is it better to hold remortgaging for another few months for those due now?
Yeah, I'm concerned about the idea of waiting a few months, I think. But I do think it's worth waiting a few weeks just to let this market resettle and clear and come back to we want competition. We all need competition in that marketplace, and we should see that. We need to we need certainty at the moment, and that certainty only comes after the Bank of England meeting. Because let's look at their options. You've probably still got 2 people on the committee who are going to vote to hold rates the same, because they're looking forward 6, 12, 18, 24 months and saying, we cannot sustain rates at 5, right? Which I agree with them. We can't. We need to go to a peak and then come off the peak a little bit. We're better off to go to 5 and 5.25, let's say, and then back down to 5 by the end of the year. It's not out of the question, but if we're going the right way on core inflation, because that sends a message that we've moved out of a tightening cycle and into a loosening cycle, which makes everybody feel more comfortable. So I think wait 2 or 3 weeks, but I don't think necessarily wait a few months, because prediction strength is quite good. I think mine's been fairly good over the last 18 months or so in terms of what the bank's going to do at the next meeting. But in terms of the external factors, they sort of creep in. Summer can be silly season, so there's not much news. There's not as much liquidity. People are on holiday. Prices can get more volatile, which is not what anybody who trades bonds really wants to hear at the moment. Apart from, I suppose, some of the psychos, Helen, probably just go, yeah, we love a bit of volatility. But you probably had more volatility than most. Even most bond traders would really want to take a few years off their collective clocks, or put a few grey hairs in their heads, or whatever the yardstick is,
Helen,
Nice
how
one.
has your lending criteria changed in the last 3 months? Like, what are pain points that you think, non-negotiable now, or I'm looking at this harder than I was looking at it? What metric were you going? It's okay. It's good to see that, but now it's like vitally important. What's kind of pushing your buttons at the moment?
Was that to me?
Yeah.
Sorry, I missed that bit. Oh God, having technical issues. Great question. I think it's much more. There's definitely like a longevity to it. Looking, I guess just getting much more data, much more stringent around the questions I already asked. I wouldn't say that the criteria or the questions have changed anymore, but one that's moved up the list, I suppose, is, can somebody run the business as well as manage a project? Yeah. And that needs to be really proved to me. Because, like we talked about cross-collateralization and all types of stuff last week, it's those type of things like now frighten me, where it's the project can look good, kind of great returns. I've never met I've never heard a time scale that's realistic yet. So we take that as a given, but it's what else is going on aside from that, because that can all go great, but it's exactly the same, Adam, as you were saying, like the external factors. What else is beyond somebody's control? What else can impact? Because that's the stuff you can't really plan for, and you're going to need to be able to get yourself out of. How do they get themselves out of that? So I look at that stuff a lot more.
I think that makes loads of sense, because I think if you went back to Piotr's point around sort of lending criteria and things like that, then you could say development and bridging finance has always been about exit, right? But it's much more about exit today. And I think the reality is, because exit is more uncertain. Yeah. I mean, we're seeing, and I'm sure you're all similar, there's much more volume of things kicking around at the moment. And it's really easy to say no to stuff, because you introduce the bigger sensitivity analysis, let's say. I mean, the idea at the moment of buying stuff to sell, build out and sell, to me, just fills me with utter dread, to be honest, because I still see, the core inflation bit still worries me in terms of the path of materials went up like a mad and then they've come down a bit. Labour's gone up like mad and maybe not come down so much. And it's probably going to still keep drifting upwards from here, as stability kind of returns as much as it ever does to a commodity-driven marketplace, right? But you're looking at probably costs, you'd be looking at 5 to 10% up over the course of a project, and prices you could easily be looking at 5 to 10% down. And that doesn't feel, and Helen, I'm interested to hear what you think, but that doesn't feel to me like a worst case scenario.
Oh no.
That feels like, you know, a 30% chance of happening, 40% chance of happening scenario. And that's so your real sensitivity at, you know, 20% up, 20% down, it's got to be very robust. And this is where the be picky, and I guess what, Helen, it's going to make you is more picky ultimately. Because, and apart from that, because you can be at the moment, because there's tons of stuff out there. People kind of really worried about developing stuff in 2020 and 2021, and that's the sort of stuff that came to the market last year and this year, right? And but either way, if they bought at sensible 2020 or early 2021 prices, I'm sure, despite the wobbles, yes, their margins might have been cut a bit, but they probably still will have been successful projects. Whereas right now, it's much more likely to be a time where you do need to be concerned. And I'm seeing lots of stuff that we've picked up, and some of the bits and bobs of, and we do nothing like the volume of trades that you guys try and do, Jay, Piotr, but we do a handful, you know, and they don't look ideal. And at the moment, you know, I'm cutting back on where I think we need to be on those, and the idea of meeting the margins that some of the volume traders do, just again, that just frightens me far too much, because it'd be too. I'm sure there's been a few bad auction days for some of the big volume traders in the past couple of weeks. I don't know if you've seen any evidence of that, but
yes is the answer.
Yes.
Yeah, and like a resounding pain. Like we're smiling because we weren't said in the last couple of weeks, but for some people that we know that were, we shouldn't be smiling, but it's a big yes. Like, you know, I think someone crystallized a 50k loss on one trade. So, you know, it just goes to show it's not all milk and honey in the land of trading real estate. But
and I think so just on that same point, like recently, like there's been a lot of traders who actually make money not really on selling on the sale price of the property. They just make money on all the extra costs they put in special conditions. And that's sometimes the only way they could make money, because people are just unwilling to pay, and they just the traders rely on people not reading special conditions, or like falling for the kind of tricks that just make people overpay.
I still really genuinely think there's a massive VAT investigation coming in that space at some point. And because and some of the bigger auction houses that have been, maybe some of the ones who've put their fees in writing and all the rest of they've overseen all of that stuff, I think they're in trouble, because I think they are the ones who've allowed that to happen. Absolutely. So the VAT man's not going to discriminate. They're going to go after the whole 9 yards. And that's without even considering some of the saltier stamp duty techniques that are used, which are illegal. Let's just call it what it is. I mean, they're illegal. There's
uninhabitable property kind of thing that a lot of them are doing.
I'm thinking the chain break. It's like, all of them have been broken chains. Oh, that's strange.
Company A that is owned by my wife failed to do this property, so I will buy it, and it's technically a chain break. Yeah, those are ridiculous. There's one.
If it looks like a duck and it quacks like a duck, my friend, you know what it is. It's a duck.
Exactly. There's one trader I know. I call him Mr. 5K because he makes about 5K per transaction, and he's selling about 20 properties a month. So, you know, that's what 1.2 million a year. If all he does is make the 5K, right? It's not terrible. I mean, it is absolute dog work. You know, he must be doing 1,000 miles a month, just going around doing pure dog work. And that 5K is on the basis that he breaks even on every transaction, and all he does, he gets his 5K of fees. That's it. That's the stipulation. Obviously, he'll lose on some and he'll make on some, but let's just call it 100K a month. It's not the kind of thing, you know, you have to be super skilled to break even on a trade.
When there's volatility, if your margins are compromised, it's very easy to turn that into a negative 5K. I mean, I said this many years ago because I'm quite boring and risk averse. Our mutual friend, our fifth musketeer, who's been with us at times on these calls, He was very kind to me years ago, and pretty much let me into his business. Opened the kimono, if you will, and showed me what was inside. And I compared it because I'd studied quite a few of the sort of volume wholesale property trading businesses. And I said to him afterwards, I said, I think you've probably got the best one that I've seen. So you haven't got the biggest volume, you haven't got the biggest numbers, you haven't got the biggest profits, you haven't got all of that. But set that aside for the moment. Your margins are magnificent and your speed is pretty damn good. Your speed could maybe be a shade better, which obviously would help your IRR, right? But your margins are spectacular. And that's what we'll protect. And that was really, I think, to an extent, because that business was born as the brainchild of someone who had his you-know-what stapled to the floor in 2008. And so he built that business very cleverly and very deliberately. So he had that mark. So rather than the pile 'em high, sell 'em cheap, he was able to do the good margin stuff, but also in decent volume. He could easily have matched the volume of what someone like a WeBuy or whoever were doing, right? But he chose not to because he didn't want to be the 5k per transaction person. He wanted the certainty, and he left those 5ks on the table for the next people, which was ideal because then I put my hand up to be one of those next people. I was very kind of it. But it was a very clever model in terms of where he took risk and where he made returns. And although it wobbled during the pandemic because what didn't, it still, to me, strikes me as a very sensible way to go about something that is inherently probably more risky than a lot of the 5k traders give it credit for being.
Yeah. I know it was mentioned a little while ago in the call, but I kind of just have a point on it. It was talking about exit strategy. Or multiple exit, or just talking about how you exit. I think Helen was talking about it with regards to her investing in other people's deals. I mean, we used to talk about multiple exit strategy all the time. Like, you have to have fixed exits to kind of, if you want to get out the deal, you can't just have the one route, which is why development always scared us. But I've been thinking more and more about the stage at which you exit within a deal and having those as multiples. So, if you were looking at someone who was buying a property and they were going to get planning, okay, planning is an exit. You've got the planning, there's an uplift, exit. Okay, you've got the planning, you've built out stage 1. Okay, now exit from stage 1, let someone build out stage 2 and stage 3, and so on and so forth. Because if all they're thinking about is the very, very end of the deal, the ultimate exit, and there's 2 or 3 ways to ultimately exit, well, yeah, that 5 years ago wasn't terrible. But for the next 3 to 5 years, that's not great, because then you're stuck in that period of stress for two years where you think, actually, no, exit now, take the profit, leave me on the bone for the next person, let them, and then move on and move out. And I think having a look at your deal, whether it's a deal that you're investing in or deals that you're doing, and thinking, right, where are my multiple exit points? And then how do I make those multiple exit points multiple exit strategies?
Yeah.
Well, this is really... Go on, Helen, sorry.
And having those conversations up front, like the deal that I'm doing with the kit ladies, we had that conversation up front. Bear in mind, we were beginning to buy this bit of land in East London in pre-COVID. Still not got the planning permission. But we had the conversations then, and they, kind of had the dream, and we were going to build this. It's going to be beautiful, and blah 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 blah. And I said to them then, it's highly likely we go in, we do this, we get the plan in, that I will want to exit then. I am managing your expectations now, that when that is approaching, you need to be thinking about how you exit me. Because and especially then, and I don't think it's changed at all, my appetite for staying in through development and all the disasters that can go on with that has really dropped off a cliff.
And my point is very much related to that, really, because when I've helped, consulted, just overall chatted with a whole number of developers over the years, some of which are long standing in the game and have got some really significant financial muscle behind them. So they don't even use financing, generally speaking. People that I was screaming at in early 2021 to say, I know you don't use financing, but inflation is coming. Go to the bank now, right? Yeah. And take the biggest, best, fattest fixed rate that you can for as long as you can, and enjoy the proceeds of redeploying that money. Although, of course, sometimes their problem can be deploying the capital, allocating the capital rather than anything else. But when I've got into it in the past, in their numbers, when they've let me in, when they've opened the kimono, generally speaking, the planning uplift sort of numbers have been spectacular, and the delivery numbers have been single-digit returns some years in a relatively stable market. It's like, if you're going through all of that for single-digit returns, you've got to be off your nut, in my opinion. And then you load in the risk of a volatile period, and you just think, well, why would you do that? So, and what you're saying, Helen, also makes perfect sense, because there's probably few people they could approach when they're talking about pre-planning granted stage, and rightly or wrongly, tons and tons of people they can approach once planning is granted. So once again, it's part of what the market tends to get wrong. But the difficulty is the skill level you need to be able to underwrite those opportunities is frankly above and beyond what you're going to get from the average, 30k a year underwriter at XYZ, a bank, I'm afraid. And so they're I understand why they do it, but they kind of lend at the worst bit of the process for me. And it depends who it depends who's delivering it. If you've got the really, really good developers on it, they make it look so easy, and I know it's not easy, but there's so few of them compared to the universe of people who want to be developers or have been developing less than 5 years or whatever. It just brings a lot of stress on, and that's why so many projects, go, as Helen said. I mean, that old government adage, and I think they go 75% over time and 66% over budget, the average government project. So at least private developers aren't that bad, right? Otherwise they'd all be broke. But 20%, 25% over time and over budget is not unusual in the first few projects you might do. I'll always remember when I was at a big London property meet one night, and there was someone on who was the CFO for a development company. I won't name them or drop too many hints, but someone asked the question, how much money do you actually make on these things? Like, the beauty of the question was it was so innocently done, because they'd done this wonderful presentation, but it's the CFO and they hadn't shared any numbers, which seemed strange to all of us, I'm sure. And all credit to him, is really honest. He said, you know what, well, on that first one, we didn't really make anything. On that second one, we were still really finding our feet on it. And it's like a list of, so basically probably they lost money on those and they used them as marketing to get into the next and bigger and better stuff, which, had things stayed on track, I'm sure would have done well. But unfortunately, they didn't stay on track for one reason or another. So, not ideal. But often there's a number of ways you can pay for your education in this game, right? And that's often one of the most direct ways that you do pay for it in reality.
Mm.
You're on mute, Helen. Just like I can see you talking.
Question. How much?
I know. I was cheering my wisdom then. I remember spending that first year before I actually started kind of investing, going around learning and seeing. I've got a very visual memory anyway, but I can still see the slide, the actual PowerPoint slide in my mind. I saw Paul Higgs talking at, I think it was probably Landlord Investor Show. It was something like that, or Property Investor Show. And him talking about the development process and basically showing exactly what you've just said, Adam, like the risk involved and the margin and what happens at every stage of that development process. And it just seemed so obvious to me. And I'm like, so that's the riskiest bit. You don't get much more out. I'm like, why would you be involved in that? Yeah.
Like, same as
with projects over that time, actually it elongates, doesn't it? So you can say, the true uplift is from land purchase to planning, and then you get far less out from the build. Well, obviously you do, because your cost implications are far greater for that second bit. So that's why it doesn't flatten or it's less profitable. It just elongates out over the project. But obviously far more risk. So you separate it out, and obviously Paul's a genius at stuff like this. But the reality is, the longer you're in a project, like a development, the profit margin elongates out. It doesn't really go up and down. unless
Yeah.
the wind changes or someone decides that concrete is now worth the price of gold, then things change, right? But yeah, still mad, absolutely mad.
There's a comment from someone on LinkedIn saying that hence, hello Abby. Hence the reason for those added contingencies, and I'm still seeing people sending appraisals to me with 5 to 7%. Yeah.
Speaks. You know what we think of that already. I would have thought. I mean, I'd imagine knowing Paul's style, there was probably a few choice words that would have applied to George Osborne or Andrew Bailey included in his liquid gold of advice that would have been coming out in that situation. But you know, it does, and this is why I've always looked at investment in the same way, right? In as much as I want to try and replicate development returns without having to do the very difficult and potentially elongating process of development, even though a refurb is a mini little micro development, really. But I look at the 3 points as in, where's the day one uplift because we've bought well, yeah. Where's the performance on the refurbishment and the value add? Hopefully, we're adding at least £1.50 for every pound that we spend. Hopefully, as a really rough guide. But if we're adding £1.25, it's not so bad, right?
Mm-hmm.
And then what's the investment performance of that? And that the exit just becomes a remortgage, which just so all you've got to negotiate is a surveyor who might be paying 32 quid to do your report or whatever pittance they sometimes get paid, who doesn't necessarily pay attention to everything they maybe should do, or is taking instruction from a bank that might have a set of what they say to you and a set of what they say to the valuers, and those two things may well not be the same thing, unfortunately. But it keeps the risk right down. But you can then see that, you know, where are your we talk about long term, you know, or total returns from property is the right way to look at it. So people sometimes get dazzled by cash flow, sometimes because the whole training industry is telling them to be dazzled by cash flow.
Yeah.
So I do feel for them on that front. I think Abby's doing all the camera work now, so that's it. Jay's lost control. He's lost control of the football. But if that's you've got to look at those component parts and then see where those returns are over time, and also not compliment yourself too much just because the market went up, right? So how much work did you do? And yeah, we've got some stuff we picked up in 2021, 2020, that long time in planning, that it's been an interest. The end figures are nothing like the initial figures. Happily, there's been a big bump in the GDV, but of course there's been an increase in the materials and labour prices. There's just no two ways around it. But because I insist on developing to margins that most people would think are either greedy or insane, it's not that material, because the end product is something that I'm keeping.
Yeah.
So once again, I'm controlling my exit, and it adds nicely to the rent roll, and it's the sort of thing we want to have over time. So will it be worth it on completion day of the project? I'll tell you no, absolutely not. Never want to see it again. But 5 years down the track, of course, I'll tell you it was worth it, and it was the right thing to be doing. And there are all those positives of, you know, you haven't got significant maintenance to be done. You haven't, you know, compared to buying a 1920s terrace or whatever, that where the roof's maybe got 10 years in it, or whatever, all these other things that can happen. So Paul, we're full of cheer today, aren't we? Full of joy.
One last question before we wrap up, from chat now, probably asking for a friend. Can you live in a property owned by your company?
I mean, the answer is yes, but the tax implications of it are unlikely to be favourable, is the easiest way. This can get quite complex because there are all sorts of interesting things around stamp duty and other taxes to do with properties owned by your company. But if you're thinking it's a good idea to sell your property to your company and then still live in it, and pay market rent to your company, where your company's going to pay the stamp duty, and you're not going to have your permanent private residence relief that you get, which is one of the big weapons that we still have, one of the big and one of the few weapons we still have left in our UK tax armory. So the only thing that makes me strongly disagree with Kiyosaki and Rich Dad Poor Dad around your home's an asset or a liability, it doesn't take into account the favourable tax position, which it absolutely should do. But it also depends on the price of that property as well. But remember, there's also the ATED, the annual tax on enveloped dwellings. So this was something that was brought in to combat the oligarchs putting a property in London in a limited company, paying 40 million quid for it, and then selling the company on to somebody else because the company only attracts stamp at 0.5%. So instead, it is what it says on the tin, annual tax on enveloped, as in properties controlled within a company. So you might well also, in a backhanded way, qualify for the ATED. So you need to really strongly consider whether there's actually any benefit. I see very few, not none, but I see very few cases where living in a property owned by your own limited company is the dominant strategy. Very few.
Plus, there will be some mortgage issues well, probably, because when you're signing up to buy-to-let mortgage, you probably, within the terms and conditions, there is a clause that says you're not there to occupy this property by yourself or your family.
Absolutely right, Piotr. And the biggest point of them all, really, because you don't want to be committing mortgage fraud. So if there's any encumbrance, you're perfectly correct.
Cool.
For inheritance, it doesn't sound bad. So when you die, it's unlikely to attract an inheritance tax.
Well, you'll have to ask whether the company's better than a trust, probably, and things like that.
It should be trusted.
Yeah, very, very likely.
The wrapper should be a trust rather than a company, but yeah.
Likely.
Phenomenal. We just reached an hour, broken an hour.
2 hours to go. Marathon day. No.
Are we taking turns? Is it like a relay? Okay, great. Well, it's been a really good chat. We'll be back next week. Thanks everyone for tuning in from all different channels: LinkedIn's, Facebook's, YouTube's, and whatever else we've got over there. And I can also see that people have been tuning in from like different locations, including Turkey, Portugal, US. All over the place. So
you want inflation? Go to Turkey. That's the way. You think we've got problems?
Brilliant. Okay, well, really good chat. Thank you everyone for tuning in, and we'll see you all next week. Have a great Sunday.
Thanks everyone.
Everyone.
Enjoy your days. Cheers. Thanks.